Hello everyone, this is Marshall Gittler speaking. I'm going to discuss the main issues facing the FX market in the coming week beginning the 7th of May. Well, we learned a number of important things in the past week. First off, about global growth. After 3 consecutive declines in the Global Manufacturing Purchasing Managers Index, or PMI, which is the red line here, it managed to rise slightly in April. This suggests that fears of a continued downturn in growth are misfounded, that global growth has at least stabilized. On the other hand, it's also true that most countries have shown a decline in their PMIs over the last 3 months. This graph shows the level of the PMI on the horizontal axis, the x-axis, and the change over the last 3 months on the vertical axis, or the y-axis. Note that alone among the G10 countries, the US PMI, at least the market PMI, is in the upper right-hand quadrant, showing an accelerating expansion, and with the PMI at a fairly high level to begin with. This explains why the dollar is so strong too, because of the strength of the US economy. The accelerating sentiment among manufacturers gives the market more confidence that the Fed will continue to hike rates. Other countries, such as Britain, are showing a slowdown in their PMIs, which may make officials more concerned about the sustainability of growth and less eager to tighten policy anytime soon. There's also a big discrepancy in inflation outlooks. The Fed said this week that inflation has moved close to their target and is expected to run near the target, as their preferred inflation gauge, the personal consumption expenditure deflator, actually is hitting 2%. By contrast, Thursday's EU inflation print was weaker than expected, and inflation actually slowed at both the headline and core level. This is a big problem for the ECB, which said back in January that underlying inflation would need to be higher than its pre-crisis average if the ECB was to meet its inflation aim on a sustained basis. But inflation is not only lower, but is on a path to miss its estimates for this year. This discrepancy keeps the monetary policy divergence trade alive and well in Eurodollar, which should lead to further dollar strength overall, in my humble opinion. Looking forward to the coming week, the big day is Thursday, when the Bank of England announces the results of its latest meeting, and also we get the US CPI, the 2 highlights of the week. Other highlights include trade figures from China, Germany, Britain, and Japan, and a meeting of the Reserve Bank of New Zealand. Let's start with the Bank of England meeting. Over the last 2 weeks or so, the odds of a rate hike at this meeting have gone from a near certain yes of 86% to an equally certain no of 9%. The sharp deceleration in GDP growth in the first quarter might have been attributed to the bad weather, but the April PMI survey showed only a muted rebound in business activity. The fact that they failed to recover to February's level suggests that the economy has indeed continued to deteriorate even after the weather improved. The question about the meeting then is not whether the Monetary Policy Committee will raise rates, but rather what they will say about the first quarter growth figures. Will they treat them as a weather-related anomaly and indicate that they're willing to look through the sluggish growth? Or do they think it may be the beginning of a slowdown, the harbinger of further weak growth to come? And how will they adjust their forecasts for growth and inflation in the inflation report that will accompany the meeting? Personally, I think there's room for a surprise here. I expect that they'll need more than 1 quarter's worth of disappointing data to change their forecast. I think the forecast could remain unchanged. That would tend to support the previous path of interest rates and could cause some short covering, pushing the pound higher. Now, the US CPI for April, also coming out on Thursday, is expected to show a further acceleration in inflation above the Fed's 2% target. Of course, this isn't the Fed's official inflation target. As I mentioned, that's the personal consumption expenditure deflator, or the core PCE deflator. The overall personal consumption deflator has so far has just hit 2% year on year, while the core deflator is 1.9%. Still, the CPI is widely watched as the common indicator of inflation, and besides, the two indicators do tend to move together, despite some differences in how they're constructed. You can see that here. The CPI is the red line, and the headline PCE deflator is the purple line. So it can be assumed that if the CPI is moving higher, eventually the PCE deflator will be too. That's why I expect this news to be positive for the dollar. We have the Reserve Bank of New Zealand meeting on Wednesday. No change in rates is likely. In fact, the market sees only a 27% chance of a rate hike at all this year. But that doesn't mean the meeting will be boring. This will be the first RBNZ meeting under its new US-style dual mandate to maintain a stable general level of prices and contribute to supporting maximum sustainable employment within the economy. We may get some concrete details on how that's working out in practice. Most analysts had assumed that a dual mandate would make it less likely that the RBNZ would raise rates. And indeed, that was probably the intention of the government when it made the change. However, with the unemployment rate already below what the RBNZ estimates to be the non-inflationary rate of unemployment, you could interpret it as meaning they've already hit half their target. So there may actually be less need for them to keep rates low indefinitely. The question then of what exactly is meant by maximum sustainable employment and whether they've already hit it will probably be the focus of attention in the accompanying monetary policy statement. Plus, Governor Orr may discuss the issue when he testifies about the monetary policy statement in Parliament a bit later. In that respect, we could see the implications of the RBNZ's mandate reassessed and the expected path of New Zealand interest rates revised upwards. That could be positive for the New Zealand dollar. Finally, China trade out on Tuesday is expected to show an increase in the trade surplus. Against the background of the U.S.-China trade talks, which seem to have broken down for now, this isn't going to be good news. It could cause further risk aversion, which would be positive for the yen and negative for the Australian dollar. Also, in this case, maybe negative for the dollar too, for the U.S. dollar. So, my outlook for the week is, for the dollar, I think given the more hawkish FOMC and assuming that the payroll figure, which will come out after I finish this recording, isn't a disaster, I expect U.S. 10-year yields to move finally above their 2013 high of 3.03% and for the dollar to gain accordingly. On the other hand, I expect the recent poor EU-wide CPI figures to continue to weigh on the euro and for the euro to decline further. Now, sterling has been hit hard recently. I think there could be a reassessment ahead of the Bank of England meeting, leading to some short covering, and the pound could recover this week. And the yen, as usual, depends on the risk attitude. I think the breakdown of the China trade talks Friday may cause a further risk-off environment, leading to a stronger yen. This is Marshall Gittler bringing the outlook for the week beginning the 7th of May. Thank you for listening, and good luck with your trading.